It's the 15th of June, and you're listening to Kopi Time, a podcast on economies and markets from DBS Group Research. I'm Taimur Beg, Chief Economist. Today, we will travel to Europe's financial capital, Frankfurt, to talk about all matters Europe with an exceptionally astute analyst and investor. Frank Engels is the head of Union Investments Portfolio Management, a position he took over on January 2018. He leads a fund management team of nearly 300 people responsible for strategy for investments totaling well over 300 billion euros. Frank has been with Union since 2012. Before taking over as Chief Investment Officer, he headed Union's fixed income business for 6 years. Now, prior to joining Union Investment, Frank has done a lot. Has he worked at a central bank? Yes. ECB. What about a multilateral organization? Yes. IMF. Hedge fund? Yes. Thames River London. And sell side? Yes. Barclays Capital. So talk about a versatile background and talk about a person who's ideally suited to tell us about where Europe stands at this critical juncture of a pandemic and structural economic slowdown. Frank, welcome to Kopi Time.
Welcome, Taimur.
Pleasure to have you on this. Frank, I've been meaning to talk about Europe with you for a long time. Let's start with the conjunctural crisis, this whole pandemic with COVID-19. We began with Italy and Spain at the eye of the storm. Then we saw many countries taking a very well-balanced approach, and I think Germany would be at the top of that, not super stringent lockdown, but at the same time, lots of socially responsible behavior on part of the population. And as a result, Germany has been fairly successful. And then we have cases like Sweden where things have actually not gone very well. So your overall take on how Europe has responded just to the pandemic, we'll talk about economics later, but just to the pandemic, and your concerns about a possible second wave.
Well, thanks, Taimur. I mean, it's a difficult, question in a sense, because obviously we should have responded way earlier to the pandemic, specifically when we learned about the pandemic sort of making its way through Asia. We should have stopped having open borders. We should have had border controls from the beginning. We should have learned from the experiences in Asia with SARS and other viruses that you should keep your distance, that you should wear a face mask, and you can extend that list quite nicely. So in a sense, we were late. All of us were late, and we were surprised how quickly the virus spread. I mean, the evidence now is that France experienced the first virus sort of trace back in December. It's most likely that even back in December, the virus had already found its way to Italy. And then, the skiing season and the carnival season and the open borders, were sort of an open invite for the virus to spread across Europe. I do think one important lesson learned from this will be to react way earlier, to be more stringent in terms of applying rules and regulations with regard to virus protection measures. And most importantly, I think the lesson is you shouldn't stick to national measures. You should have a common European pandemic plan in place that you adhere to and that you act on. In that sense, I hope the lesson learned will be to coordinate better across borders and across governments in Europe, because Europe, as we all know, is the most integrated and most open sort of economic region in the world. And the ties are numerous between businesses and families alike. So in that sense, there's a clear evidence that we need to act more stringent and more coordinated and according to a common plan. That I think are the most important lessons learned from COVID-19 in Europe.
But Frank, has that lesson been absorbed by the governments? I mean, right now we're seeing different parts of Europe on very different page. Are there attempts to have a better coordinated response for the, say, second wave?
Well, in a sense, yesterday the news were that Germany, France, Italy, I think the Netherlands, and correct me if I'm wrong, there was a fifth country, maybe Austria, are planning to buy 400 million antidotes of the from AstraZeneca, actually a UK-based pharmaceutical conglomerate. Interestingly enough, so in that sense, I do think there are lessons being learned as we speak between across governments in Europe that they need to coordinate better. But you're right. I mean, if you look at the way we are relaxing rules and regulations, the way we are gradually opening borders very differently across countries, clearly we haven't gotten to the point where a common plan would be adhered to and action being taken accordingly. So in that sense, I do think the next EU summits, and not only the one that is coming up very soon, but it will take a couple of, if not a few more meetings to coordinate on this and to have a common understanding on how to respond to such threats in the future. Now, with regard to the second wave, I'm a bit concerned that we are already seeing signs of a second wave, not only in Europe but across the world. And with borders being opened up as we speak, it's probably too early. The second wave is probably going to hit us too early to have a really common response to it. So every country is going to stick most likely to its lessons learned, to its sort of course of action. So what I've been talking about in terms of lessons learned is probably a vision for the next 2, 3, 4 years, so that we are more ready and better prepared next time a new virus hits.
Right. I see some parallels between the heterogeneity of response in the United States of America and the heterogeneity of response in the United States of Europe to some extent. Hopefully lessons for the medium term. But speaking of lessons, Frank, beyond the issue of pandemic, of course, Europe has been dealing with a structural economic slowdown. In the southern part of Europe, there has been protracted debt crisis and fiscal issues. So are there any specific lessons that Europe is learning from COVID-19?
Well, in a sense, there are a few important lessons. Let's first start with one very important structural lesson, and that is that you have to be very careful on how you restructure or reorganize and sort of consolidate your health sector. And what I'm referring to is the experience of Italy. We recall that the virus hit in the most developed and most affluent part of Italy, which is actually resembling, in terms of its structure, in terms of its wealth, in terms of its infrastructure, very much northern European countries like Germany, like Austria. Now, the virus hit the hardest in that part in the Lombardy, and in that part of northern Italy. Why? Because one, it's the area with the sort of highest content of industrial production in Italy, but more importantly, the health sector got consolidated after the European debt crisis in Italy, specifically in northern Italy, where many local hospitals closed down and where you had only a few sort of mega hospitals in the city centers of the larger cities. And the virus struck exactly in that region where you had consolidated your health sector to a point where you were not able to respond to the virus outbreak in a more sophisticated manner. So clearly, one lesson learned in an economics way is that we are all looking at a way on how to make our health sector more efficient without closing down hospitals all over the countries. And clearly, the EU health agenda has been pushed forward or has been boosted by the experiences of Italy, of Spain, and others in how to organize the health sector in a better way, not in a more efficient way, I would say, but in a better way to be more responsive to virus outbreaks like the one we've seen. More generally, I do think there is, through COVID-19 and the enormous real economic damages that come from the lockdown all over Europe, there has been a recognition that we need to have a bit more solidarity in terms of how we help each other in terms of crisis. Fiscally, that means there are not only, parachutes that would allow countries to tap certain credit lines in sort of European emergency funds, but more importantly, there's the first time that the European Union talks about transfer payments across countries to help each other out in terms of economic or fiscal pain. So in that sense, I do think there's a first step and a first recognition that even at times of a systemic shock like this one, which has been sort of symmetric across, in terms of its origin across countries, but very asymmetric in terms of its impact locally across countries, there is the recognition that you need to have a step forward, not only a monetary union, but also a fiscal union. And we are seeing the first signs with the EU recovery plan, the EU recovery fund, as well as the European Union's budget, that we will have a fiscal stimulus that targets specifically the weaker economic countries in terms of providing not only credit, but also transferring funds to these areas to help them getting back on track.
Frank, you have been following Europe your entire professional career. I remember when we were colleagues at the IMF, you were at the UK desk. Later on, you were at the ECB. So you've basically seen the European project since the currency unification. Are you more hopeful than ever before in terms of the prospect for a fiscal union?
Well, I do think the time has come to make a bold step forward. Otherwise, the European master plan would soon be in shambles, because quite honestly, with debt levels and economic developments diverging further and further across countries in the region, with every new economic shock, be it a fiscal, be it a financial, be it a real economic crisis like the one we've seen right now, or we are seeing right now, clearly divergence comes to a point where it's unbearable unless you make a step forward. So it's a make it or break it type situation for Europe, I'd say. And some of the politicians, specifically Monsieur Macron, but also Madame Merkel, have clearly recognized that it's not the time to continue doing as we have been doing in the past, meaning, we stick together in a monetary union with one currency and with some political union sort of measures or structures. But clearly the all-important fiscal union has to be put forward to make it more stable and more successful going forward, the European project. So clearly, I do think if we don't go to that down that road, then the likelihood of a ultimate breakup of the EU into different parts, a northern or a southern part, as discussed many times during the EU financial and fiscal crisis, the debt crisis in 2012-14, then we are at a crossroads. So clearly, I do think there's a need for more fiscal unity and a more solid EU in general. And there's a political recognition in some parts of Europe for this necessity, but it's by far not the opinion in all member states at the moment. So clearly, the odds are out whether this will be the all-important move towards more unity in Europe.
Right, and of course, we are having this discussion just days before the EU summit. On the 1st of July, Germany will be taking over the rotating EU presidency. Are you expecting major outcomes out of the summit?
Well, we hope that the recovery plan, which foresees targeted measures, as I said, including fiscal transfers to the to those areas of the EU which have been impacted more heavily by the virus, like like Italy and Spain. That's clearly a first step into the right direction. And if that plan succeeds, which I would at best place a 50% likelihood on, then we have made a first real step into the right direction. But clearly, the smaller economic countries have Austria, for instance, Finland and others, the Netherlands, have sort of other ideas about how to proceed in Europe. So the odds are out whether this summit will be a success or not. Clearly, very importantly, as we all know, you have to have unity in terms of the votes for or against the measure. So this sort of unanimous voting principle will be a big obstacle also at this EU summit in terms of the recovery plan and the fiscal stimulus program. So I'm a bit hesitant to say, this might be or this will be a historic summit. But if they were to push this through, I think this would be a major indication forward, also for capital markets, to understand that the EU sort of project is back on track and delivers fiscal transfers across increasingly divergent regions, which is how you should go about it, as we all know by textbook.
Absolutely. Frank, I've been in the private sector for well over a decade now. I've never felt market pricing ever favors Europe. It always sort of favors the US. But when I look at the dollar's weakness over the last month or so, 6 weeks or so, and the fact that the euro has been sort of picking up a little bit, it seems to me the market is expressing some confidence about a little more strength in the decision-making process in Eurozone. We'll see. But Frank, in terms of, and we'll talk about markets in a minute, but beyond sort of the general issue of fiscal stimulus and fiscal support, what are the specifics? If indeed there were to be significant additional fiscal space opened up tomorrow to spend money, where will Europe spend money on? And one thing that I have in mind is, of course, climate change related issues. I saw Germany last week launching like a 10 billion euro strategy on boosting the use of hydrogen. I'm sure there are many other green technology and carbon emission reduction strategy that Germany and others are pursuing. So maybe climate change is one, but could you sort of walk us through where will Europe spend the money to boost growth and go forward?
Well, clearly, there is a recognition that the climate change sort of plan should not be abolished because of COVID-19 and its economic damage to the real economy. In that sense, I do think it's a good example to look at the German fiscal stimulus program, which had specific measures, as you mentioned, for instance, for the hydrogen energy strategy of the country, but also of the European strategy on that matter. But more importantly, the program was silent for the first time, actually, on specific support to the traditional fuel combusting motors in automotive industry in Germany. There is no specific premium being paid to customers who buy new cars who run with diesel or petrol for that matter. So clearly there are a few specific measures entailed in the fiscal stimulus program that have a clear green paint to it. And the tilt that is in the program is also reflected in the European fiscal stimulus program, which has a specific sort of investment concept underlying innovative industries who are trying to deal with the CO2 emission reduction plan that the EU wants to stick to over the next 25 years. So what I'm saying is I don't have the specific measures in terms of what exactly will be invested in, but clearly anything that is limiting the CO2 emissions of the European Union will be part of the Green New Deal that Miss von der Leyen, the EU president, has been published a few weeks ago. So in that sense, there's the economic difficulties and the damage to the real economy in Europe have not led politicians to diverge or to stray away from the restructuring or rebuilding of the economic structures, targeting a more environmental friendly Europe going forward.
So Frank, I have traveled around Europe. I don't see too much of a deficit as far as infrastructure is concerned, at least physical infrastructure. I also have friends in research and development in European universities. They never complain about a lack of research grant. So when we talk about larger fiscal support measures to boost growth, is there actually a deficit in infrastructure? Is there a deficit on R&D? Or am I, talking about things that really don't need much more additional support?
Well, there's one area where, if you think about traditional infrastructure in terms of roads and train tracks and so forth, airports, then I do think there's no deficit in that. But if you look at the sort of the new age infrastructure, meaning digital infrastructure, high-speed internet connections and the likes, then clearly Europe is way behind the curve relative to other regions of the world, be it the US, be it Asia, be it also Switzerland, for one example, outside the EU, or be it the Nordics. In that sense, I do think anything that has to do with digital infrastructure, there needs to be a beef up of investments out there. In terms of R&D, anything related to new technologies like hydrogen, the hydrogen strategy, excuse me, that will be important to be held up in terms of R&D funding and investments into these industries. But clearly, I don't think we lack generally investments relative to GDP or incentives to proceed in R&D. It's more, the new technologies that have been neglected relative to other areas of the world in terms of political and financial support. Right.
Frank, from Euro area's domestic issues, let's move a little bit to the Euro area's external issues. Now, Europe, of course, has a fairly high trade to GDP ratio. It's benefited immensely from China's growth. And as we now see a lot of tension between the US and China, surely it makes life complicated for European leaders. They don't like what the US is doing, but of course, they are not an out-and-out ally of China either. Where do you see the politics and economics of Euro-China relationships going forward?
Well, it's, as you said, it's really a difficult position to be in. In a sense, U.S. politics have become much less reliant, specifically in terms of trade politics, but more generally in terms of the political course of action in the US vis-a-vis Europe and the rest of the world. So clearly, European leaders are a bit stunned, to say the least, about what has been coming out of the US in terms of the political agenda over the last few years. Now, so in that sense, Europeans are, of course, worried to some extent that what they have been doing over the last few years, namely focusing more on intensifying the Sino-European relationships, not only on trade but also on research and development, on infrastructure projects and the likes. The One Road, One Belt project, for instance, clearly has led to a tightening of relations between the Chinese and the European Union. And that makes it now obviously even more difficult, given the fact that the US is targeting China on many accounts. G5, the new high-speed communications network is just one. 5G is just one example for that. In that sense, the Europeans are trying to steer a course to sort of muddle through. In a sense, they don't want to upset the Chinese in terms of the relationships that have been built over the last 4 or 5 years. Specifically, also in the southern states, like in Italy, where China has a quite intensive relationship with Italy on many areas of fiscal and economic policies. More generally, so you want to steer through that and not upset the Chinese too much, but also not upset the US too much. So in that sense, it's a very difficult course of action. And given the fact that the Europeans don't speak with one voice, usually on external policies, that is obviously making life even harder for Europe to sort of be a partner that is playing or sort of acting, at level playing with the Chinese and the US on international policies. So I'm to cut a long answer short, I'm not sure we have a good strategy on how to deal with this. I do think everyone is literally hoping for the US presidential election to come up with a new president who has a more sort of integrative approach to foreign policies, be it the US-Chinese policies, but also the US-European relationships, be it on trade or on military support.
Yes, you and many, many others, Frank. Okay, so the other external issue, I have in front of me the BBC website, and it says, War of Deadlines at Brexit Summit. And apparently you guys are at loggerheads with the Brits on fishing rights and a few other issues on competition rules. Can you give us a sense? Because, we sort of forgotten about it. So many other things are going on. So refresh our memory and tell us how much of a risk is there as far as the Brexit process is concerned.
Well, I mean, we all lived through the fear a couple of years ago that a hard Brexit could happen, and that sort of fear and danger it hasn't faded yet, given the fact that by end of this year, the sort of transition period by which the rules have been sort of sorted out and agreed upon on how we interact between Europe and the UK in terms of economics, in terms of trade, also on many other areas of our relationship, that deadline is approaching fast. And by all means, not only because of COVID-19, but also obviously because of it, there has been a huge delay in these sort of bilateral talks between the EU and the UK government on sorting that out. I do think the underlying issue is, at least according to the European view, that the British try to sort of cherry pick the relationship, in a sense that they look at other trade relations, for instance, and other trade treaties, and pick and choose those sort of regulations and stipulations that are favorable to them. And so there's a sense in Europe that the British try to mastermind the perfect Brexit treaty for the British, and that the EU is concerned that they set a bad precedent if they were to give in on that, be it fishing rights, as you mentioned, be it competition rules, be it access of the financial industry to European customers on the continent. So that sort of financial passport that was heavily debated. So in that sense, I don't see right now, given how preoccupied the British government is with itself, but also on how preoccupied everyone else is with, dealing with the negative impact of COVID-19, be it in Europe or in the UK. I'm very skeptical that there will be a solution found that can put us forward and avoid a hard Brexit by end 2020. So in a sense, what is needed, obviously, is a common understanding that you again extend this transition period, which means that there will be ongoing uncertainty with regard to what type of trade regime do I have to adhere to, what type of duties and taxes do I have to pay if I invest in the UK, or vice versa if British companies invest in Europe. So there will be this prolonged period of economic uncertainty and political uncertainty that is definitely not helpful for the sort of fostering the relationships in terms of economics, but also in terms of politics between the two sort of areas, the EU and the UK going forward. So I'm actually concerned that there's not enough focus, neither in markets nor in politics, on this problem right now. It might escalate over the next couple of months going forward, specifically after the summer break. But there won't be enough time to get a deal done.
Right. I remember, and I'm sure you do too, that stations, the tube station in London, I think Bank, that always says, mind the gap. So we have to mind the gap on this issue. Frank, we've spent quite a bit of time talking about economics and politics. Let's talk about markets. When you look at yield curves in the US or Europe or even in Asia, none of the fixed income market participants seem to be worried at all about inflation. And the Fed and ECB can print all the money they want. They can buy all the bond they want. And all that happens is some asset price inflation, but nothing with respect to inflation expectations. Are we living in this strange post-economics reality world? I mean, what we learned in school seems not to be working in real life.
Well, that's a good point. I mean, to be quite honest, I do think we all going to get Japanized or Japanificated, how many people call it. So if you look at the experience of Japan, then clearly the measures undertaken in terms of fiscal support and monetary support, in terms of almost unlimited amount of money spent on bond purchases and the like, equity purchases, on top of it, stock purchases. So clearly, if you look at the experience of Japan, there is a clear notion that you can go on with that type of regime for quite a long time and provide a sense of stability for as long as the government can credibly indebt itself further, and for as long as the central bank is credible in purchasing these assets without steering hyperinflation or leading to capital flight. In that sense, you need a stable current account, and you need credible politics, both on the fiscal and monetary side. And then it's almost like a Ponzi scheme, I'd say, a sort of macroeconomic Ponzi scheme that works quite well for as long as you keep being credible and don't lose trust in the currency. And that's what we're seeing in Europe and by all means in the US as well. We see, as you pointed out, almost no expectation of future inflation, at least in the short run. And you see enormous trust by investors into the actions undertaken by the fiscal agents and the central banks. Now, but I'd say you mentioned there's almost no sign or almost no indication in markets that there could be a fear of inflation going forward. And I'd like to point out on that note that there are a few signs of that in markets, actually. If you look at, obviously, on the way how sort of the safe havens against inflation trade, be it gold, be it other sort of precious metals, but also be it cryptocurrencies, who have been sort of redetected by investors as being one means of protect yourself against inflation. But also if you look at the yield curves, the very long end of the yield curve, specifically the long end of the yield curve in Europe, specifically the Bund curve, has steepened quite nicely over the last few weeks, and showing the first signs that investors want to have or want to hold a higher term premium, sort of being paid a higher return for holding this type of debt over the longer term. So I'd say there's some economic uncertainty premium in terms of inflation uncertainty being priced into bond markets for as long as we don't have to deal with virus angst like today and over the last couple of days, when obviously other effects dominate capital markets. But clearly, the long end of the yield curve, I would watch carefully. I would expect these curves to deepen further. One, because of inflation expectations picking up as we recover from the COVID-19 crisis. And second, because of the enormous supply of new debt that needs to be issued going forward to fund the fiscal spending programs that have been put to place by government.
But Frank, if the officials at ECB and the Fed are also worried like you about the long end of the yield curve and want to suppress those yields through some sort of a Japanese-style yield curve control measure, then where will we see the uncertainty manifest? Will it just manifest in crazy run-up in corporate debt prices, and or there'll be some liquidity crunch in an inadvertent way, or would we just see big continued booms in equity markets because there's no yield to be had on the fixed income side?
Well, yeah, that's a good point. I mean, the lessons learned over the last 2 or 3 decades have been that clearly inflation is manifests itself in terms of asset price inflation, not necessarily consumer price inflation. And in that sense, and if you recall, for instance, the recent judgment by the Supreme Court in Germany against one of the purchasing programs of the ECB, where they basically criticized the ECB for not explaining sufficiently why they have been purchasing all these assets, given the fact that interest rates have been very low and have fueled sort of an asset price inflation in terms of house prices. So they wanted to have a better explanation as to why these measures need to be taken, what is sort of the relativity of the measures in terms of its impact with regard to, for instance, asset price inflation. And clearly, what you see is, and what is the normal outcome, if you expect inflation to come up over the medium because of sort of the fiscal monetary policy mix across the globe, then there's no way around equities. There's no way around certain commodities, and specifically so if yield curve control would be kicking in Europe, in the US, sort of Japanese style, going forward to contain a further rise in long-term yield. bond yields. So clearly, in terms of our view on what that means for real economic assets like stocks, where you own parts of the company, that should be the true long-term winners of that type of macroeconomic policy that we're seeing right now.
So Frank, I mean, I was mentioning earlier, and we haven't really touched upon this explicitly yet, but the currency angle that, you have a dynamic where the US is also now at the zero bound, and therefore the impetus for a chronically strong US dollar may have dissipated. But of course, if the euro were to now appreciate, that would not be particularly great for the whole inflation or disinflation debate.
Yeah, that's fair enough. But there are a few things happening as we speak, and you mentioned that earlier on in passing. Over the last couple of weeks, we have seen a quite notable weakening of the US dollar. It happened to coincide with a rise of US investors' interest in, channeling capital investments back to the European continent, which hasn't happened for quite a few years, actually. So there was over the last few years, we had a huge lack of interest by foreign investors, specifically US investors, into Europe. And over the last few weeks, this has notably changed. One, as you mentioned, the interest rate differential is way more favorable right now. Second, from a European point of view. Second, and more importantly, the U.S. Investors are looking at their own country, at their own COVID-19 strategy, at their own sort of internal politics. We're just seeing this sort of clash of racism in the U.S. That is openly debated also in the commercial circles and by large cap U.S. enterprise leaders. So clearly, they're looking at Europe and they're figuring out, well, it's not all doomed in Europe. It's not all bad. And they're seeing specifically a German government that is for the first time running a huge fiscal stimulus to contain the crisis. And they're seeing that other countries in Europe, and specifically also the European Union, are acting and getting their act together on some of the more sort of medium-term measures like, climate reduction, CO2 reduction, climate change initiatives, the Green New Deal, as I mentioned. So what we're seeing is a resurge of interest in European assets by specifically US investors and to some extent also Asian investors. And that is clearly underpinning also the sort of weakness in the currency, in the US dollar, and the strength in the euro. Now, is the euro so important in terms of the inflation debate going forward? Is the strength of the currency the most important issue? I don't think so, to be quite honest. But if you think about the most important determinants of inflation, consumer price inflation, then it's still wage inflation and and labor market developments that are the main driver of core inflation. Looking at that, so the currency as such. Ongoing dollar weakness, ongoing euro strength against the dollar wouldn't make me too concerned about deflationary developments in Europe, to be quite honest. That is not the main driver of inflation in Europe and or the US.
Right. I mean, if we were to successfully push up labor productivity and then labor were to get paid for that higher productivity, we would have the good kind of inflation and it'll be a win-win for everybody. Frank, last word. As somebody who has talked to us about Europe in this podcast, but of course manages assets across the world, when you look at the entire global investment landscape, where is value remaining for investors right now?
That's a good point. At the short, in the very short term, I'd say the most value is probably right now in value assets, in the sense that if you look at cyclical assets, which have been pricing in basically, the global recession we are seeing right now, that these type of assets should respond and have responded over the last few days at least quite nicely to the increasing expectations that the global economy is back on track of a sustained recovery, and that even a second wave would not lead to the same sort of lockdown measures with a sort of detrimental economic impact that we'd seen in the first wave. So what I'm saying is, from here onwards, the global economy should recover, and gradually so, and those assets which have been most heavily negatively affected by the economic damage should recover, smoothly going forward. So that, I do think, is a neat strategy to look at industrial supremes, to put it that way. So the leader of the industrial sort of part of the economy, in terms of the companies that had the way of the economic recovery, and I would put my money into those stocks going forward. So that's one part, and the second part is clearly we are looking at investment grade debt, which still is nicely priced in terms of the spreads that you can earn vis-a-vis bonds or treasuries or for that matter. So we do think fundamentally good selection of investment grade credit and selectively even high yield credit is what you should be looking at in this crisis. The fiscal measures that have been taken are partly related to the fact that they provide balance sheet repair for some of the more heavily impacted companies in the world. And most others will benefit a lot from the sort of demand impulse that is coming from fiscal and monetary policies into the global economy over the next couple of quarters. So clearly, fundamentally sound investment grade credit is something you should have in your portfolio going forward.
Right. Almost sounds like a long euro, long European equities, and long European debt strategy. Frank Engels, mon ami, thank you so much for your time and insights.
Well, thank you, Timur, and thanks for having the pleasure to be on your podcast. And all the best to you guys in Singapore.
Thank you, and all the best to you. Thanks to our listeners for their time as well. This podcast is purely for information purposes, and the views expressed here are personal. You can find all of our group research publications and multimedia by Googling DBS Research Library.